Welcome to this analysis of Era Group Incorporated as part of the Burke and Road Reports program at Tulane University A.B. Freeman School of Business. My name is Emma Collada, and my fellow analysts are Gregory Cohen, Austin King, and Harrison Mona. The presentation will begin with a company overview, followed by a summary of the stock performance, an explanation of our investment thesis and valuation method, and a glimpse at Era's financial performance and projections. We predict a 12-month target price for Era of $30, which signifies an investment rating of market outperform. Era Group trades on the New York Stock Exchange under the ticker symbol ERA. Era is a Houston-based international helicopter operator that largely services offshore oil and gas drilling rigs in the Gulf of Mexico and Alaska. Era provides helicopters to the offshore energy industry and offers search and rescue, flight seeing, air medical, training, and dry leasing services. Here's a look at Era's stock performance since it split from Secor Holdings in January 2013. As of November 18, 2014, Era was trading at $24.92 with a market capitalization of $507.7 million and 20,370,000 shares outstanding. Era's 52-week high is $34.64 and its 52-week low is $19.53. The outlook for oilfield services over the next 12 months is negative due to low oil prices. Lower oil prices equate to less drilling activity, which leads to reduced demand for oilfield services. Because Era derived 75% of its 2013 revenue from oil and gas clients, Era is vulnerable to risks inherent to operating in a low-priced oil environment. The remainder of Era's revenue came from leasing helicopters to the U.S. government and foreign affiliates and for flight seeing, firefighting, search and rescue, and air medical operations. Era buffers this risk by using 3/4 of its fleet to service the production side of the business, which is not as affected by the decline in pricing as the exploration side. We expect Era's clients to continue drilling in unconventional deepwater reserves as long as the price of oil remains above $70 per barrel. Era's light and medium weight fleet limits its ability to profit from deepwater expansion. Although oil prices will cause a temporary decrease in demand for oil drilling, the demand for deepwater drilling will continue to increase. Deepwater drilling requires the use of heavy helicopters, which specialize in traveling long distances to deepwater oil rigs. Era currently has 9 heavy helicopters, whereas some of its competitors have as many as 144 heavy helicopters. Era's fleet size and heavy/fixed wing aircrafts compared to its main competitors can be seen in the figure. Era's limited supply of heavy helicopters will hinder its potential revenue in the near future because its medium and lightweight helicopters are unable to command the same premium day rates as competitors' heavier fleets. In an attempt to catch up, Era has ordered 14 heavy helicopters to be delivered before 2017, with the option to order an additional 15 heavy and 4 medium helicopters. Although this purchase will significantly increase expenses and reduce net income in the short term, Era's investment in heavy helicopters is necessary to compete in the oil and gas services industry. Hence, investors can expect to see weak net income growth over the next 12 months as a result of these investments. And thus, low net income will result in a lower earnings per share ratio, which may discourage some investors. Era's joint venture in Brazil trades high rewards for high uncertainty. Since its July 2011 investment, Era has experienced repeated difficulties collecting revenues from its joint venture partner Aroleo, an air support provider to the Brazilian oil and gas industry. The aircraft that Era Group has in Brazil represent just below 20% of the company's total fleet value. Because of multiple contract cancellations by Aroleo's biggest customer, Petrobras Brazil, Aroleo has gone from providing 10% of Era's total revenues in 2011 to providing only 5% in 2013 and owes $27.8 million to Era in deferred revenues. Petrobras currently has $170 billion in debt, making it the most indebted oil major in the world. Petrobras executives are currently engulfed in the scandal of a bribery and money laundering scheme that has illegally transferred hundreds of millions of dollars from Petrobras into the hands of employees, contractors, and politicians. Petrobras has hired 2 independent law firms to look into whether or not it will have to readjust its financial information, making future revenue payments even more uncertain. Aera's helicopters allow the company to compete in markets outside of the oil and gas industry. Aside from oil and gas support, Aera provides aviation services such as search and rescue, air medical services, firefighting support, and sightseeing. Governments continue to privatize search and rescue services, which carry especially high margins that Aera Group is positioned to take advantage of with its light and medium helicopters. The resignation of Aera's CEO indicates an approaching change in management. On August 28, 2014, the Chief Executive Officer of Aera Group, Sten Gustafsson, resigned. The Board of Directors appointed the current Chief Financial Officer and Executive Vice President, Chris Bradshaw, as the interim CEO until a permanent replacement is found. Mr. Gustafsson has served as CEO of Aera Group since April 1, 2012, and played an instrumental role in managing the company during its divestiture from Secor. During this transitional period, we recommend closely monitoring Aera Group's operating performance. We used 4 valuation methods to arrive at a 1-year target stock price for Aera Group of $30. To reach this number, we used the multiples forecasting methods price to earnings, price to book value, price to cash flow, and enterprise value to EBITDA. We used Aera's main competitors, Bristow Group, CHC Group, Ericsson, and PHI, to calculate price to earnings, price to book value, and price to cash flow peer comparison ratios. For enterprise value to EBITDA, we excluded Bristow Group from the comparable firms because of its relatively high enterprise value to EBITDA value that skewed the peer group average up by 27%. Although we originally forecasted using the discounted cash flows method, we decided that the multiples methods are more reliable yardsticks for Aera Group because they better account for Aera's heavy investment in tangible assets. To evaluate Aera Group's 1-year price target, we made several operating, investing, and financing assumptions. These assumptions are key in driving the company's revenues and expenses. Our model utilized the size of Aera's helicopter fleet as the key driver of revenue. We were able to derive a meaningful correlation between Aera's helicopter fleet size and revenue. Taking into account the company's guidance for purchases of helicopters over the next couple of years, our team was able to estimate Aera's average annual revenue per helicopter. We adjusted this value as the future purchases of heavy helicopters will raise the average revenue per helicopter. If the company chooses to purchase more heavy helicopters than previously indicated, this will raise Aera's earning potential and thus adjust our price target upwards. Aera's operating and general and administrative costs were forecasted as a percentage of revenue. We expect that the historical correlation between these costs and revenue will continue. In addition to the future heavy helicopter purchases identified in the table, the company has options to purchase an additional 19 helicopters during this time period. We did not factor any of these options into our evaluation because we are uncertain whether Aera will exercise these options or when the helicopters would be delivered if Aera does so. We forecast that the company will be able to finance its future operations and asset purchases from its operations and credit facility and without the issuance of further equity or long-term debt. We believe that under historical operating conditions, the company will be able to pay off its $200 million of 7.75% senior notes when the notes mature in 2022. We believe that at least $5 million and $60 million will need to be borrowed under the company's credit facility in 2015 and 2016, respectively. We do not believe that these borrowings will lead to any adverse material changes to the company's financial performance. Under predicted operating conditions, the company should not have trouble repaying these credit facility obligations. From myself and the rest of the Aera analyst team, thank you so much for your time.
The Berken Road Reports are produced solely as a part of an educational program of Tulane University's Freeman School of Business. The reports are not investment advice, and you should not and may not rely on them in making any investment decision. You should consult an investment professional and/or conduct your own primary research regarding any potential investment.